This is Hillary Kramer. We are at the San Francisco Money Show, and I am here with Mark Hanf and Edward Brown. Mark is the president of Pacific Private Money, and Edward is the head of investor relations. Welcome, and it's just wonderful to have you here today because you provide alternative investing options for investors looking to make some money from other places other than just straight equity or straight bonds and debt. Tell me about your business.
So at Pacific Private Money, we're an alternative real estate finance provider. We're the place people go to when they need a plan B, when bank financing isn't an option. We're the fast, reliable source. We cost more, and that's how we're able to provide our investors a return, which this year is averaging about 8% secured by real estate.
Okay, and in terms of your real estate investments, can you share with us how the safety and security of them, maybe the diversity of your investments, your location, how you go about making the investment decisions for those investors who might invest in you so they understand your business better?
Right, so we're a California lender, so we lend only in the state of California, mostly in Northern California. People come to us when, for example, maybe they've switched jobs, maybe they're self-employed, maybe they're going through a divorce. There's a lot of situations where bank financing is not readily available. It takes too long to get, and in this market, especially in the Bay Area, home purchases have to close pretty quickly. And so we're the guys that you can call, especially if maybe your bank financing was approved and fell out last minute. We're the call that you make and say, hey, I got to close by Friday or am I going to lose my deposit? So all of our loans are just like the bank. So they're secured by real estate. So unlike stocks and REITs and other types of investments, we have collateral backing ours. People who invest through our company, we're just like the bank. They can either invest in our mortgage pool fund if they're more of a passive investor.
Okay.
We also work with seasoned note investors too, where their name is on the note, their name's on the deed of trust. They get the yield of the note less the servicing spread. So we work with both types of investors.
Okay, so that's very interesting. So a potential investor should know you can be part of the overall fund and be diversified in your investment. And there are also opportunities that you present to your investors in terms of being in backing specific transactions.
And our average loan to value in the fund is only 56%, so it's very, very conservative. And again, we're getting mortgages on houses, and sometimes it's apartments or commercial property, but we actually have a recorded deed of trust.
Right, and what most people don't realize is that in private money, which is what we're called, sometimes it's referred to as hard money, we're actually more conservative than the banks. So our loan to value rarely exceeds 70%. We're usually 70% or less, and as Edward said, the weighted average loan to value in our portfolio right now in our $40 million fund is about 55%. So we're very well secured, and for that we're paying just a little bit under 8% right now in our fund, and our note investors can get generally between 8.5% and 9%.
8.5% to 9%, that's an amazingly wonderful, excellent return. How do you see, now that we are, in terms of the equity bull market, in kind of the ninth inning, we are looking at rates rising. How do you position your business, and how should investors look at what you're doing as an alternative that would make sense in this market?
Well, the key to our business is that we only make short-term loans. Our loans are paid back on average within 6 months.
Okay.
So real estate, even though people say, well, what about if we had another crash like we had 10 years ago? Well, it took 3 years for real estate to go. It was a slow decline, so real estate prices don't actually go down that quickly. So in our loans, even if the market when it starts to go down, our loans still make sense because if we're lending at 70%, our investors' capital is still safe.
Also, because our loans are short term, we're not getting caught in an interest rate environment where we're making really long-term loans, where if interest rates go up, we get caught in a low interest environment.
Okay, that's very valuable information and very helpful for investors who are looking to diversify. So I appreciate your time today. Mark, Edward, Pacific Private Money, an opportunity, an alternative investment vehicle for those looking to diversify and allocate beyond the equity and debt and cash portfolio that you hold.